Hey there, it's Megan, and I wanted to talk to you about a presentation we had in the office last week with Louis Vasquez. He is the owner, founder of Profit and Wealth Tax Advisors. Louis is our personal advisor, and he is a very smart cookie. I feel so blessed to have him come in the office and give this presentation to us. And so I just wanted to go over it with you. And I want to first tell you that I am not allowed to give you tax or legal advice because I am a realtor. So anything having to do with real estate, I'm your gal. But taxes, legal, that sort of thing, you should just check with the person who you know, like, and trust to help you out with your tax and legal questions. But I do want to go over this packet that Louis left with us. And I want to also let you know that if you would like a copy of this, you can just shoot me an email or a text and I will send it over to you. So, right here, this is for the sale of commercial or investment property. So, let's say that you have a fourplex and you sold it for 1.5 million. How much are you going to owe in taxes? Well, here's what they consider the cost basis, which is the original purchase price of the fourplex. In this case, it was 250,000. They must have owned it for a really long time. Then the cost of escrow, Louis had it here at 112,000. He's counting the real estate commissions. Yes, they're tax deductible. So make sure you hire the best realtor you possibly can because their fees tax deductible anyway, and you're paying taxes. So they've got real estate commissions, title fees, escrow fees, transfer taxes, that sort of thing. Louis got the cost pretty high there. The cost is less. If you want to know how much it would cost for you to sell your investment property, just reach out to me and I'll tell you what the number would be. The cost for prepping for sale, 10,000 he has here. He means painting fences, repairing restrooms, etc. That is the cost for preparing for sale. So that's different than the cost of owning it over the years where you've made all these repairs and that sort of thing. This is specifically for preparing for sale. So if you take those numbers here, you subtract them, you've got a capital gain of 1,127,500. And then you have to add back the plus sign, your depreciation recapture. So when all these years, when you've been writing off the depreciation and using that to lower your taxes, you have to pay that back. It gets right added back in. So in this particular instance, the net taxable would be 1,202,500. Now, we talked about this in the meeting. Like I said, don't believe everything I say. Make sure you verify it with your trusted advisor. But let's say that you have a $1.5 million investment and you die. It's going to happen to all of us at one time or another. And you have some children and you've left your property to them, then their new base is not 250,000 like yours is when you bought it. Their new base is the value of the property at time of death. So let's say it's 1.5. So all these taxes would go away. Okay? So check with your people, make sure everything I say is right. But so it makes sense to hold on to things for as long as you can, usually, unless you're selling it to buy something better or you just can't take it anymore. Or you just want to sell everything and travel the world. Whatever your reason is, I'm sure it's a great reason. I'm just going over all the possibilities here. Now, sale of a primary residence. The rules are different for your primary residence. So let's say you sold it for $1.5 million. You bought it for $250,000. The cost of escrow, again, your realtor fees, escrow fees, title fees, all your fees are right here in the tax deduction line. So once again, why would you shop for the cheapest realtor who may not be the most competent or with the most experience when it's actually a tax write off to get yourself the best experience that you can get. That's just my opinion, and I'll move on to the next thing. Home improvements made over the lifetime of ownership to the property. Home improvements. These are expenses improving the value of the home, not expenses incurred for repairs to maintain the house. Okay, so for specific, what are those? You can reach out to me, but for this one, it was 500,000. And so that brings the capital gain to 637,000 minus their primary residence exclusion of 250 for one person or 500 for joint filers, which brings their net capital gain or loss down to 137,000. Then this explains what is your principal residence exclusion. It says that you have to have lived in the house for at least 2 out of the last 5 years. If you needed an exemption, you'd have to have a reasonable cause to sell the house, like a medical, that sort of thing, job transfer. All right. Like I said, you can email me for a copy of this. Now let's talk about long-term capital gains rates, because there's a lot of people around here that have owned their house forever, and now they've got this in this scenario here, $137,000 capital gain. How much are they going to have to pay in taxes on $137,000? Well, if you're single and your income, let's say you're retired, is up to $49,449, it would be a zero tax rate. So you can read across this line here: 15% for people making over 50,000 and 20% for people making over 545,000. So most people that are retired are probably going to fall into the 0 to 15%. So 15% in this scenario of $137,000 is, I'm going to guess, about $20,000. So it's not that much. It says, is this state or federal? Let's see here. Long-term capital gains, federal income tax limits. The state will have a different tax, I believe. Sale of an inherited property. This is what I just talked to you about earlier. How you get a step up in basis. And that is pretty much the explanation of this meeting we had last week. As always, if you have any questions, feel free to reach out to me. And for a copy of this presentation, also feel free to reach out to me.